follow blockchain topics, you probably heard this quote from Larry Fink, the CEO of BlackRock, this week. He was speaking on a panel at the World Economic Forum, and I think this quote from the leader of the world's largest investment management platform really grounds the conversation that I want to have today. So I'm going to start with Larry Fink.
I think the movement towards tokenization, decimalization is necessary. I think we need to move very rapidly to doing that. We would be reducing fees. We would do more democratization by reducing more fees if we had all investments on a tokenized platform that you could move from a tokenized money market fund to equities and bonds and back and forth. We have one common blockchain. We could reduce corruption. So I would argue that the activities are probably processed and more secure than ever before.
So the topic today is real-world assets. Why are people in crypto so excited about talking about these things? And in my mind, having covered this space for, 7, 8 years now, I feel like there's two kinds of crypto people. There's the money types, the investment types. It's the business crowd, and it's the folks who want to make a profit, right? Then there's folks like me who are more the culture types who came here for the vitality and the narrative. And what has vitality, folks? What has narrative? What is a sort of technology that makes people feel alive, that makes people feel like it's really living? Dogecoin. Dogecoin has vitality. Say what you will about Dogecoin, it seems to be this thing that is like living out there and every now and then like resurrects itself like a zombie coming from a grave. But if crypto is never anything but Dogecoin and variants on that idea, well, there's a ceiling on this whole thing. The big insight of the money types, the business types, is that whenever anything can save money at scale, even if it's just pennies per deal, as long as there are thousands or millions of deals, that's a real business. That's potential, and that's growth that will win. And so that's our topic for today, is real stuff, not the Dogecoins. Real stuff coming on chain. The term of art for that these days is real world assets. We're talking about real world assets today on Diamond Rhino. So, hello, and welcome to this, our 6th episode of Diamond Rhino. My name is Brady Dale, and I'm the host of this show. Diamond Rhino is also a part of the Substack newsletter Front Stage Exit. If you stumbled on this podcast on some other podcast player, or you saw it on Reddit or Twitter or something, welcome. Glad to have you here. If you like what you hear, go to frontstageexit.com and sign up for the newsletter. And then if nothing else, you'll get reminders in your email inbox every time a new episode of this podcast comes out, but you'll also get other content. I do an essay every Tuesday on some big topic, sort of like this podcast does. And then on Thursdays, I do this column called Backstage Pass, which is a wry and sardonic look at the news of the week in cryptocurrency. So thanks for being here. One thing that would really help if folks are liking the content so far, I know most of you found me via Substack, but if you have decided you're going to keep listening to these, it would be great if you went to your podcast player of choice and subscribed to the podcast there, whether that's Apple Podcast or Spotify or Overcast or whatever. It reaches all of them. I'll include several links to the specific places you can get the podcast on those different platforms. But it reaches them all, and it would really help to have you sort of making that direct relationship through your pod player. Thanks a ton. This episode, for me, really captures what I'm trying to do with Diamond Rhino, because we're diving into a complicated topic that can get pretty technical. And so this is our chance to I went through a bunch of the content that's out there, and I plucked out the parts that allowed me to assemble some kind of a narrative here so that you can get all of this more quickly without having to wade through 14 other conversations like I did. And that's the point of Diamond Rhino, is to get the crucial nuggets about these different topics out and to explore them for you. If you've been a trader or a meme coin type who's been waiting to get up to speed on this hot topic, this definite trend of 2025 and 2026 real world assets, this one is for you. And I'm going to be honest, this is one of those topics that I also have neglected somewhat up to this point, because it just seemed like a little too buttoned up. Back when I was still at Axios and I was writing the Axios crypto newsletter with Crystal Kim, who's now at Investopedia. You should go check out her work there. But I would always encourage Crystal to take these topics because she was the more business news minded of the two of us. But obviously we've got to get here for it to be real. I mean, if crypto is the future of finance, it needs to deal with like actual finance. So I've been putting it off because there were crypto punks that I could still write about, and that was still a worthwhile story. But now we're here, and I'm caught up, and you can be too. So we're doing this today because it's important, and this is like I think this will probably be like the crucial trend of 2026, or at least a crucial trend. And real world assets fit into a larger thesis that I've been kicking around for a while. And I'm going to preview that thesis for you here at the end of the show. So stick around for the end because we're going to go 50,000 feet here in a way that might be useful for you over time, or at least will be interesting and somewhat thought-provoking. Now, let's dive in on the state of play for real-world assets here as we begin 2026. With moribund Bitcoin, a semi-disappointing crypto president, market structure legislation looking doomed, but real crypto regulations on the horizon. So we started with Larry Fink at BlackRock. Let's close the opening here with a great quote from a legend of decentralized finance, Robert Leshner. He was on the Bankless podcast in March of 2024 talking about this topic. He's the founder of Compound, which is one of the original money markets in Ethereum. But these days, he's the leading leader and co-founder of Superstate, which just landed an $82 million Series B financing led by Bain Capital and Distributed Global. And Superstate is at the forefront, the vanguard of this exact topic of bringing real-world assets on-chain. So far, they've mainly brought on U.S. Treasuries, but they have a vision to go much bigger than that. So here's Robert talking about the state of play for this sector.
There's no question that in 30 years, blockchains are used for natively issuing the equity of a company. Why not? Like, why? It's obvious that it's just a better record keeping system. And like, of course you're going to use it instead of what I will tell you is a horrible back office mess that things currently work on. Right. So obviously, like, individual stocks and bonds are going to be tokenized or issued for the first time on blockchains. From there, obviously every fund is going to have the ability 30 years from now to be running with an on-chain component. We're not limited just to T-bill funds. Equity funds like an S&P 500 fund or a NASDAQ fund or, a real estate, REIT fund or commodity funds or any type of fund can and will be issued on chain.
So real world assets, what does it mean? Let's start off with the term. Some people hate this term. In one of the conversations I heard, they said it sort of sounded infantilizing, like the stuff that exists on blockchains now isn't real somehow. But I understand the point that people are making. I mean, there's a degree to which it's not real. It's like purely digital. It's purely on blockchains. Real world assets are, of course, assets that are backing or are invested in things that exist in actual atoms in the world, that home loans or car loans or other sorts of lending along those lines. Or they could be cash flows. Money market funds, a lot of those are based on cash flows of different businesses. Leshner couched this pretty well on that Bankless podcast.
A lot of work has occurred over probably, I would say, the past 6 years to bring off-chain assets, which in my opinion are just assets that are originally recorded, not on the blockchain. They're assets that are recorded in some other type of ledger, whether it's a spreadsheet or legal contracts or pieces of paper. And the goal is to bring them on chain where they are in a superior function over the way they used to reside. When assets are on chain, they're more useful. You can move them around pretty much instantly. You can see a huge level of transparency into who owns an asset, what they're doing with it, how it works, what the rules of the asset are, and they're programmable. So people can build new things with those assets. And this began to capture people's attention, in my opinion, probably going back to about 2017 or so. We started to see lots of experiments going all the way back. Many different teams were trying to either tokenize securities or tokenize real estate or tokenize commodities. None of them really came to fruition. The one asset that got tokenized incredibly successfully were dollars. Really starting in about 2018, we started to see the rise of stablecoins. And stablecoins are the first assets where there was an asset held off-chain And through a process, the value of the asset was moved on-chain.
And just to zoom out a little bit here, we saw this same narrative take place with the internet, and people would complain about it being infantilizing, but I just think it's silly to do that. It's just some things are purely online and some things aren't. The internet really became indispensable after around 2007, when people started to be able to do things like order a car to their actual location, Uber, or they started to be able to get meals delivered to their house. We call that the transition of the bits to atoms era of the internet. And that's what we're seeing here with crypto too, that for a long time, everything in crypto was purely crypto assets, like stuff that just existed on chain, which it has real value, but it's just not the same as like a house or a business. So anyway, at the end of this last year, A16Z Crypto, which is obviously a part of Andreessen Horowitz, this gigantic venture capital fund, and one that has taken a lot of bets on crypto. They had a discussion where they talked about how far the sector has come in 2025 with, they say it's $30 billion in assets under management, not counting stablecoins. RWA.XYZ puts a slightly smaller number on it. Either way, it has grown a lot over the last year. So Robert Hackett from the content team used to be at Fortune. He covered a lot of crypto stuff there, and then he came over on their State of 2025 episode. He brings up the issue and sort of frames it, and then Darren Masuoka from the investing team sort of lands the importance of the topic on the podcast.
If we're talking about these other types of assets, everything from stocks to commodities to debt of all different flavors, there's about $30 billion worth of that on-chain today. And it's growing very rapidly. 2020, there was almost nothing to now 30 billion. So what's going on there? What's driving the growth? Tell us about this trend.
So first of all, I think real world assets, so I think they're the key to the long-term success of DeFi, because this is the bridge to traditional finance, which, as we know, is many trillions of dollars of size in opportunity. And so I think we have to, if we want kind of DeFi to really reach the levels and scale that I think we think it can, I do think we need to bring these real world assets on chain.
And then a little bit later in the conversation, Eddie Lazarin comes in and he gives what I think is a useful thought for us in this conversation about how what's unpredictable and interesting about real world assets is how they're going to lead to second order effects that we can't foresee.
Tokenizing a company and putting it on chain is maybe only an incremental improvement, but I still think it's exciting insofar as it creates exciting second order consequences, like stablecoins, right? Like stablecoin is just dollar on chain. It's not a new asset. It's the old asset, but on a new medium. And that has profound consequences because of all the profound ways that dollars are used, right? They're used for payments, they're used as collateral, they're used for settlement, they're used for all these things. I think for stocks, it could be similar. It's like if people hold a lot of their assets on chain, well, now they're on chain. And that means now they're interoperable with a lot of other things.
So hold that thought from Lazarin. I like Lazarin, by the way. I think he has a lot of smart takes. He's very tech forward. So I like how he thinks through a lot of these things often. So hold on to that thought, because it's going to be crucial when we get to that thesis, I promised you then. But the other thing is just to sort of expand on what Lazarin said here is what's so exciting about technology is this notion of emergent phenomena. And emergent phenomena is especially powerful when you are networking lots of people and getting lots of people involved in stuff, behavior together. That leads to unpredictable things. It's impossible to predict emergent phenomenon. Like no one knew when they created the internet that cat videos are going to be such a giant thing. And so we can't anticipate what the emergent phenomena in the crypto enhanced with real world assets world will be. But the one thing we can feel fairly confident about when we look at the fact that at the start of 2025, there was much less than $10 billion worth of real world assets on chain, not counting stablecoins again, and how that has gone up to 20 to 30 billion by the end of the year. Things are moving quickly, and that trajectory really strongly suggests, looks a lot like the early days of DeFi, that we are super early in this space. And that's something that Robert Leshner also spoke to on the Bankless podcast.
When you asked, like, why hasn't it worked yet? Well, the world hasn't really been ready for it yet. We're at a very early point of like infrastructure existing on chain for assets. We're at a very early point of investors wanting a upgraded file format for their assets. We're at a very early point of support for these assets, whether it comes from custodians or intermediaries. And I think it hasn't happened yet because really this is the beginning of what I see as the next chapter for digital assets.
So why does anyone care about this topic? Like, why does real world assets matter? So the big idea in tokenizing real world assets comes down to an age-old way that the internet has always won again and again, the thing that has always made a lot of money online. And that is automating things that have largely been done manually or close enough to manually in a large scale so it makes them work better and be cheaper. And it has made unicorns. So what you'll hear in the following section of this is folks talking about different ways in which real-world asset tokenization does that for a number of existing industries, which have a lot of money under management. So first of all, let's kick off with Lucas Vogelsang of Centrifuge spoke about some of the ways in which that manual element of finance as we know it can be automated away and made less expensive when he appeared on the Defiant podcast with Cami Russo in October of 2023.
A lot of this finance world, like, sure, it happens online and to some extent, but it hasn't properly been digitized. So like when you think of invoice financing, like factoring, like oftentimes you have like between 0.5% to 2% in annual fees that like 10 different service providers charge that are all kind of disconnected. So we have someone that values the individual invoice, someone that like does risk management on like maybe the borrowers. You have a company that just does auditing and reporting to the investors. You have the lawyers that make sure that all the paperwork is in order, right? And they all like basically they send around spreadsheets. That's like finance is run by spreadsheets today in most cases. To borrow money, if you're in one of these asset classes, it's much more expensive because as an investor, it's so much harder to trade and sell and kind of price these assets. And that's what's called the illiquidity premium. And now, why am I talking about this? Because, well, like, right, like one thing that's magical about DeFi is that by being 24/7 fully automated and smart contract governed, actually a lot of these like transactions are so cheap that you will start to see liquidity for assets that are very small, right? Like on Uniswap, a token that has $100,000 market cap, like you can still have active trading. You can have $20,000 in Uniswap liquidity and it works, right? In the TradFi, you need to have like a $10 billion asset class and like people trading it all the time for like there really to be a liquid market. AMM's completely changed this. DeFi actually has this opportunity to kind of like make more of these assets tradable, like easily priced, more liquid. And that's generally good for everyone involved, right?
By the way, just so you know, and I do this sometimes and I always call it out, that quote from Vogelsang was actually a few different quotes all spliced together that he gave throughout the episode. But just so you know, we'll say that here on the podcast. I'm not going to always point it out, but I do clip things together or cut out bits in the middle sometimes, just if it seems like it's more efficient. And when people talk, they wander off in all these different areas. So it's all getting to his core point, but just so you have transparency into that kind of thing. So another way in which real world assets is beneficial for users, for markets, for market participants is like, particularly let's like use the example of tokenized equity. So tokenized equity has been something that has been talked about for years, putting stocks like Tesla and Apple and Coca-Cola or whatever on chain and letting people own them as on-chain assets. Gabriel Atta of Denari, one of the leading firms in this space, talked about sort of the simple advantage you get when you get stocks and equities like actually tokenized for real and you put them on chain.
I think overarchingly, the goal for us has always been how do we bring capital markets on chain in a sustainable and legal and compliant way? It is the biggest asset class, stocks, right? Even simple things you can imagine, like swapping an Apple share for a Google share directly. You cannot do that off chain today.
Tokenized stock, by the way, is worth noting that it's had a hard time coming together. It's been sort of a weird topic. It's something that's been talked about since the very beginning. A lot of companies have said they have done it in different ways. There's been everything from synthetic stocks, which we saw on platforms like Synthetics, which is an early DeFi platform. There was Mirror that was a part of the Terra ecosystem. Terra, the blockchain with the stablecoin that completely blew up. So those were synthetics. There's also things that people do where they'll just buy a bunch of stocks and they'll sell tokens that are meant to trade as if they're the stock, but all they are is a derivative of the stock. And the theory is that they should follow the price of the stock, but they don't really, because it's just not the same thing. It's not actually the stock. And so obviously it's going to have a lower price. And then there's just weirdness of how it's structured and is it redeemable and all that kind of stuff, which is also going to lower the price. So it's been a problem. Nari, what they said on this podcast that he was on is that they've actually figured out a way that you can have a token and have it just actually be a stock with all the rights that you would expect. But he also notes that being able to do that like at real scale for like lots of stocks, that's just going to be a long time before it gets there. It's like, this is very much a gradual process going a company by company way. Then there's companies like Ondo, which take a different approach where they grant that they don't really give you a stock. They have a bunch of the stocks, but what you get is still more of a derivative. But they've been careful to engineer it in a way where you get the main thing that most people want with having a stock. People don't really care about participating in governance. What they care about is that the stock will have the value they expect it to have. So if it goes up in value, if they have this token, the token should go up in value or fall in value so that it actually matches that price and they can participate in those gains. It's like the most important thing. Ian DeBode, Ondo's chief strategy officer, broke down what they sell.
So our tokens are issued as wrappers, meaning that what you hold on chain is the economic exposure to the underlying. Our model, there's different models out there, right? Some people tokenize stocks, and when you look at the fine print, they're not backed one for one. So what you're really then buying is a derivative product. We don't really go for that model. We believe it is much better to always back something one for one. And even on top of that, have a collateral buffer so that a user can always rest assured that the token they're holding is fully backed and then some.
So yeah, the other funny thing that tokenized equity does is it just allows things to trade with a lot more capital efficiency. So this is something that Atta explains. If you have equity now, if you're a holder of stocks, it takes time to be able to trade them.
On the user side, simple things that we take for granted on the crypto side will now be enabled for stocks. Most people, when they're wanting to buy a stock, they're usually not putting new money into their brokerage account. Oftentimes, they're actually coming out of another position and going into another position. And that can be instantaneous now in a way that hasn't been before. I mean, honestly, like people should try it. Like if they want to take $10,000 worth of Apple shares and sell it at Schwab, just wait to see how long that money actually lands in your account for it to.
Because it has to go through these hops, right? It has to go back.
It takes a couple days. I mean, T+2 or T+1 is like a death sentence in today's news cycle.
The simplest justification, though, for why real world assets are important and why they're valuable, particularly for folks in crypto, is it just very simply allows there to be more kinds of reliable, trustworthy collateral on chain. And if there's more collateral on chain, that means more lending can be done on chain. So DeFi, the core of DeFi has always been making loans against collateral. We have better collateral. If there's more collateral, more loans can be made. And of course, those loans can also be tokenized, and it just sort of opens up the world much more broadly. And that opening up of collateral is something Ian DeBode has talked about in September 2025 with Cami Russo on the Defiant podcast.
Fundamentally, at Ondo, we believe that tokenization makes sense to do two things. Number one is you want to enable access to a global audience by putting the asset on crypto rails. And number two is you want to enable these assets as some form of collateral on chain. But those are the big two reasons why you would put an asset on chain in the first place. When you look at both of those, having the right pricing transparency is actually very important for both. And if the value of the thing is not entirely clear, no serious DeFi protocol is going to allow you to use it as actual collateral.
So as long as we're talking about lending and collateral, let's talk about private credit. So we're in the middle of a giant meltdown in the crypto and policy world right now over bank lending or stable coins, and stable coins getting yield going to wreck the bank credit market. But it turns out, if you are following this conversation, but you also zoom out and sort of look at the world of bank lending, that a lot of lending is getting done anymore by folks who just want to see yield on their money and are turning that yield over to companies that can find good borrowers, whether those are people or small businesses or whatever. And that's private credit. And private credit has got something like $2 trillion in assets under management. So obviously getting any piece of that market on chain could be huge. And so while everyone's talking about the banks and whether or not they're all doomed from stablecoins, there is this whole other market out there which would be, if not easy, at least straightforward to get on chain, and it would be super transformative. Remember what Larry Fink said. He thinks all the traditional assets out there should eventually be tokenized, and it should all go on one blockchain. So just think of how epic that would be for coin that represented any given blockchain that happened to win that. And any of them that get a meaningful piece of that $2 trillion market, and again, that's just one category of potential real world assets that could go on chain, that starts to look very, very big. In fact, I didn't ever think I would say this, but as I was looking at this topic and I was looking at those numbers, it actually started to make me think that there is a possibility where you could imagine a chain that could actually flip Bitcoin in market cap. Nobody clip this quote and show it to the Bitcoin maxis. And I honestly, if you'd have showed it to me 4 months ago, I would have thought I was crazy. But now that I start to think about this, it's just, it looks pretty big. And so we're talking about borrowing, we're talking about private credit. DeFi started with borrowing. That was the beginning of decentralized finance. And Mary Gunarate, she's a co-founder of this real world assets company called Loopscale. She gave a pretty good history of crypto lending on the Lightspeed podcast this last August.
I think, there were the 3 milestones in innovation, DeFi lending. And the space is relatively new, so that seems like a fine pace of innovation. But you started with a pool-based model, which I think was the best for the time, given all the constraints between Ethereum, the fact that the main goal was to bootstrap liquidity. No one knew if there was borrow demand. Then you had Morpho come in with, okay, we have proven borrow demand. We need to be able to allocate capital more efficiently and give people more control over risk. And so I think that was the next innovation. And then I think, the next iteration is okay, we have isolated markets now, which are hyper customizable, and we have pools, which are hyper liquid. It's what is the third evolution that lets you preserve both liquidity and scalability? And I think that's where you get something that looks kind of really this hybrid order book model where you can deposit this a pool like structure, but the underlying liquidity layer is all order book based.
But things she said that I really liked and which really opened up this whole conversation for me to a certain degree. She said this on the Talking Tokens podcast with Jacqueline Melanik earlier this month. And she describes sort of the power of transparency that comes with putting real world assets on chain.
But the true step function improvement, especially from a risk perspective that crypto brings to the space, should be that you have the visibility of all cash flows down the line, and you're not just looking at a spreadsheet to explain what and I think that's what caused the great financial crisis, and that's why ledgering and that visibility and that downstream is so important. Where it's headed and to kind of be convergence with private credit and publicly issued is you'll have these different lenders that are making loans to the end borrowers, and they will be reaching end users in the same way that you use a credit card today. And those loans will be packaged up into a basket of assets, and all of that will be visible, and you will know who the end borrower that is generating every cent of yield on a multi-billion-dollar fund, all on chain.
And what I love about this clip is it captures what's honestly a real potential here, is just dramatically increasing the transparency into a bunch of lending products. I was in the midst of the financial crisis in 2008. I was back in my do-gooder days. I was working on bank reform in the state of Pennsylvania. We were complaining about all the predatory lending that was happening, all the lending to people who really shouldn't be getting home loans that was going down, that all of that led to the subprime financial crisis of 2008. And after that all started to unwind, one of the things we began to learn about were all these structured lending products where thousands of homes would be into a pool together. People would buy cash flow rights off of those loans, where the people with the junior tranches would get a higher yield, but they would be the first to lose money if some of the loans turned bad, and the people with the senior tranches got lower yield, but they got the lion's share of the money. And all of this, lots of these, it was a bit of financial chicanery to make it look like parts of these packages of loans were really high quality. Actually, it was all garbage, but it was a way of splitting them all up and obfuscating it. And one of the points that Gunarate makes here is as part of the story that we saw, if you were following that closely back in 2008, 2009, and 2010, is that a lot of these packages, it got hard to even see what was in there. It got hard to have transparency about what the loans were, or like what kind of quality work was done to like verify those loans. And it just all got to be very confusing, even for the people who were deeply in this. And so this idea that putting everything on chain and having that stuff all follow the actual asset around, because it all could be connected digitally on chain, this is a really powerful idea. I mean, who knows how well it will actually work out, but one can see that this could bring a lot of transparency to this market. The thing I remember from that era, I used to be a big fan of the Planet Money podcast on NPR. It arose out of the financial crisis, and they would do these shows where they explain different pieces of it. And one of the funny things they did is they bought a toxic asset. The group pooled their funds, and they spent $1,000 to buy $1,000 worth of one of these, packages of mortgage loans that I talked about. And they did a bunch of stories about it. I would have included some quotes from that here, but it's now all behind the Planet Money paywall, and so I can't get to those old stories. But they're out there. I'll link to it in the show notes. You can see a teaser about it. This bit of the story made me remember Toxie, their little toxic asset they bought in I think it was 2010 they actually bought that. The new DeFi, I guess you call it DeFi, the new tokenized real world asset company that kind of blows my mind is Figure. Figure is a company that is opening up more home equity lines of credit for people around the country. So basically, you've got a home, you've paid off a fair amount of it, or maybe it's gone up in value a certain amount. And so you've got some wealth in that home. So you are home rich, but maybe you're cash poor. And a lot of people borrow money against their homes, and they're able to unlock that capital a lot of times to improve their home, so to improve the underlying asset, maybe for other things as well too, maybe for emergencies. This is a very lucrative part of the banking world, but the thing that drew my attention to Figure was that they have this kind of stable coin, Figure HELOC, which is backed by a bunch of these home equity line of credit loans. It's the 11th largest token on CoinGecko, and yet you hardly ever see it talked about. It's just behind Dogecoin. Dogecoin is worth $20 billion. Figure HELOC is worth $15 billion, and it's just ahead of Cardano, which is at $13 billion. But this is a real world asset token that is pushing the top 10, and one expects it'll be there. And yeah, looking up at the rest of these, other than the two stable coins that are in there, we don't have any real world assets in the top 10. I mean, stable coins are real world assets for sure, but they're kind of a category in themselves. And so this idea of providing home equity lines of credit through DeFi rails, it was pretty compelling. And Mike Cagney, the founder of Figure, explained on the Bits and Bips podcast how blockchain technology enabled them to streamline what used to be a much too hands-on process, so that it actually was worthwhile to make these loans to people whose houses weren't of the value that typically used to have access to this product. So it costs too much for banks to do the due diligence to make it justifiable to do these home equity lines of credits for a lot of the smaller homes, like the $200,000 or $300,000 homes. But because they were able to use blockchain technology, Cagney explained, they were able to make it a lot more simplified and streamlined, and that got the cost down. So they were able to open up a whole new category of home equity lines of credit that other people weren't serving. And he talks about that on the podcast.
The way the industry's evolved, to do a Fannie Mae or a Freddie Mac eligible mortgage costs about $13,000. And so if it's a $200,000 mortgage, $13,000 is 6.5 points. There isn't a market you can sell the loan in for 6.5 points. Because of the efficiencies we captured through blockchain and the capital markets that we built out through blockchain, cost us less than $1,000 to produce that mortgage. So, we have over 250 partners now that use our technology to originate loans, including 10 of the top 20 mortgage companies.
So this company went public in September. So we had another crypto company up on the boards. Again, nobody really talked about it a ton, but I think it's a really big story I think it's really interesting. And Cagney talks about how DeFi has been one of the crucial difference makers for his company. This is a really bullish indicator for these sorts of assets coming on chain and for the possibility. This isn't like a theoretical thing. This company is really doing it and is making nice returns off of doing it. Like they're making like actual money, enough money that the public markets were like, sure, let's help you go even bigger. And then going back to Gunarate of Lukescale, she talks about how lending in DeFi has been a little bit stuck on one model over time, which is the pool model that was innovated by Aave and Compound. So go back to my Aave episode for that, find it on the Diamond Rhino page. But Loopscale is also tokenizing loans between two people, which allows for things like fixed rate lending, which is something that we haven't really seen in DeFi so far. See, most lending in DeFi is you take out a loan at whatever rate it's at, but markets determine what the rates are. It could go wildly up in the next few weeks, and you've got no control over that. And you really don't have there's not a ton of options for fixed rate lendings out there. But if you're doing deals between two people, then it is a lot more feasible for those loans to have one rate over time. She talked about this on the 11 a.m. podcast back in September.
One of the biggest kind of differences between us and pool lending protocols is the base primitive is a loan between two people, and you can parameterize that loan in the same way kind of a TradFi credit product works. And what that actually unlocks on like a user basis is one, capital efficiency. There's a ton of like idle liquidity requirements with the pool-based model. Two, and this is kind of what I think is the most important aspect, is you're bottlenecking growth when you have these kind of huge startup requirements for a credit market and you can't launch an asset with a credit market off the bat.
So yeah, if I'm understanding it right, what she's doing is a lender comes along who has a certain amount of money to lend. They find a borrower, they give a loan to that person, and then that loan gets tokenized. And once it's tokenized, the lender can then sell that loan off to other people who are ready to buy it on chain. So they get that revenue flow from the loan. The lender now has their capital back. Maybe they made a little profit off of the sale, and then they can make more loans. So you have the person who is good at originating, sort of focusing on originating, and other people who like that idea of getting that capital flow from loans can also get in on that as well. And it can trade, and it can those tokens can go into other protocols. So there's just a lot of possibilities that unlocks. And to the point that Gunarate makes about why this kind of lending lowers the startup effort required is when you're doing the pool model, you've got to get a bunch of people to put a bunch of money into the pool to have enough money there that there's liquidity for people to borrow from. But with the approach of the one-to-one tokenized lending, you can get started with as little as one lender who has some money that they're ready to lend. And the thing that Gunarate points out is this kind of model of providing private credit in different sorts of contexts is something that has worked pretty well on the internet. Things like the buy now, pay later sort of lending. That's the kind of thing where people are finding market participants in places where they might not have considered that credit was a possibility and putting that option in front of them. And so that's sort of the business that Loopscale's in, is sort of like helping people see that the moment they need to see that. And she explained that in the Lightspeed podcast last year.
Like a lot of people, especially traders, don't necessarily have like an immediate contextual use for borrowed capital. It's like, why would I even borrow? What do I need to borrow money for? Mm-hmm. And so you need to kind of do that step for borrowers of like, show them that there is money available when at a point when they think they might actually need money. And a lot of that, the ability to build that out hinges on kind of composability and permissionlessness of that composability. And so for us, I think the kind of next phase is making it super easy for anyone to tap in.
So Gunarate's company, Loopscale, is doing well so far. I mean, it's small for a DeFi protocol, but it's coming along quickly. They've got about $100 million in assets under management right now, according to numbers on DeFi Llama, with $60 million borrowed from those assets as of this recording. So, real money's moving. So big picture we're looking at here is real world assets is connecting blockchains to stuff like cars and homes and businesses and invoices and cash flows. Like this is just the stuff that makes the world turn, that like literally moves goods around the planet. And so let's take a look. Let's go to rwa.xyz. It's a website that's devoted to real world assets, and just like take a look at the numbers there. So they're saying that real world assets right now are around $23 billion. Of the stuff that is tokenized on chain so far, we got about $9.5 billion in US treasuries. We've got about $4 billion in gold. So yeah, that's a real world asset that's been working for a long time. Both Paxos and Tether have tokenized gold products, and those are, people buy those. In fact, on that A16Z episode I talked about it before, Eddie Lazarin talks about how he had a feeling gold was going to do okay, and he decided it made sense to just buy some gold on chain. So he has some of Pax gold, and it's done, everyone knows gold's done awesome. So private credit on chain, as we just talked about, that's about $2.4 billion. And institutional alt funds are at like $2.2 billion. The leading blockchains for real world assets right now out there, according to RWA.xyz, the Canton network is by far the leader. This blockchain called Provenance is number 2. And then the third is Ethereum. Ethereum is the biggest place for real world assets. Again, not including stablecoins, though obviously Ethereum is also the biggest one for stablecoins as well. The front stage exit editorial view is that open public blockchains are the best for the world, and we hope they'll win. So we would like to see, obviously, Ethereum dominate this space. So far, it's being crushed by Canton, notably, but there is still a ton of use out there for Ethereum. And Vivek Raman of Etherealize, sort of the business development company for the whole Ethereum project, argued at the Real World Asset Summit last year that he believes this is Ethereum's game to win.
I think it will be winner take most. I think there's use cases for a lot of different blockchains, but ultimately for real world assets, for institutional settlement, institutional trading, doesn't have to be the fastest, but it has to be the most secure ecosystem where Wall Street's comfortable with the next trillions of assets. We think the L1 as the base layer Ethereum, and then L2 model is the right one. It's pretty expensive to bootstrap a new L1 from scratch. It's a lot easier and it's a lot cheaper. And honestly, it's a lot higher margin to build an L2.
Obviously, as a fan of public chains, we hope he's right, Ethereum or Solana or something like that. But there's a very real chance that the point I want to make here, though, is Ethereum is the number 2 blockchain, like by far right now. Like I said, Figure is number 11. Obviously, we have 2 stablecoins that are in the top 10 of biggest cryptocurrencies in the world right now. But there's a very real chance, if things keep going like they are, that there will be some shakeups in the top 10 next year, and that we will see some tokens or coins that are related to real world assets like move into that space and move some of these more purely crypto plays down in value relative to some of these projects. I mean, who knows? Anything could happen, but it just, when you look at these numbers, that starts to seem like more and more feasible all the time. A lot of times in crypto, we talk about things that could happen, how things could work, like a business that could be successful. But this really is happening now. Like I said, we've gone from like $6 billion at the start of 2025 to like 24, 25, maybe $30 billion now. That is like very real growth. Those are industries that can pay a lot of people's mortgages. You know what I mean? So with all the talk right now, the focus in the crypto world is on this market structure legislation in the Senate, which if you've been following me on Front Stage Exit, I don't think it's going to pass. I think this legislation is already doomed. But it kind of doesn't matter when you start thinking about it. I mean, it matters. It matters a lot, but it also doesn't matter for the health of the overall crypto industry once you start thinking about things like real world assets, because this is the kind of stuff that existing regulators know how to wrap their heads around. This is like a thing that they can understand and manage. This isn't really complicated for them. They know what to do with this kind of stuff. Like figuring out what to do with a governance token that earns some money from an automated market maker like Sushi. Like that's a tricky and weird question that it's going to like have a bunch of lawyers like scratching their heads and deciding pros and cons about like what to do with for a while. Like, is it a security? Is it a not? I don't know. But what to do about just like, for example, private credit moving to a new substrate? Yeah, regulators can swing that like no problem. This is why God invented regulatory sandboxes. And with a friendly administration who is open to experimentation in this area, my bet is that real world assets are going to chug right along this year. And of course, this stuff is also different because it's so clearly a security. And so that has to be handled under known existing legal restrictions. If there's one thing that Paul Atkins and others in the SEC have been clear about, is like taking the thing that everyone knows is a security and putting it on a blockchain changes nothing. It's still a security, still subject to all kinds of laws, such as bank secrecy laws. But fortunately, founders in this space are well aware of that. Gabriel Atta of the Denari Project spoke about that on Bankless in a completely sane way.
We call it DeFi on Rails. That's a way to bring all of the DeFi features to our end users with our tokenized stocks, but not violating securities laws. That's important to us.
So it is an exciting time for boring things. It is an exciting time for boring things going on chain. So how big is all this going to get? Is everything going to be tokenized? Sergey Nazarov, the leader of the Oracle Network Chainlink, obviously wants to see it all get bigger and bigger, and he talked about that on the Wolf of All Streets podcast.
But what you want is the base asset that backs the rest of the financial system, whether that's tokenized funds, tokenized real estate, whatever category, you want that asset generated in your financial system because you want that asset to then be bought externally, right? So the first step in getting your financial system to gain the benefit of external consumption is that your financial system is the one where the asset is generated. And our view is that the asset will become what we call a unified golden record, where the asset is now a form of ownership. There will be kind of a data container attached to the asset, to the token itself. And that data container will be dynamically updated near real time.
But as someone who's been around this space for a long time, I liked the note of caution that we got from Jen Sinhaji, who has been around basically roughly as long as I have. She was a part of the MakerDAO world, a true OG of the DeFi space. She now works for the Oracle Network Chronicle, and she was on stage at the Real World Asset Summit last year. And she talked about sort of how she feels when you hear folks start to say that they want to tokenize everything.
It reminded me of like the different phases throughout crypto that I've been a part of since 2017, where it was like, everybody should have a DAO. Everybody should have a blockchain. And it's like, absolutely not. Like, yeah, we learned those last time. Maybe not everything should be tokenized, but I think we're figuring out like what sticks, what doesn't. So there is certainly value in having that open mindset.
And in fact, as exciting as all of this might be, and as more importantly, like as bullish as all of this might be for crypto assets and for DeFi in particular, even the biggest proponents of this evolution want to see it happen in a gradual way. One of the things that Atta of Tenari was really good about is understanding that the US capital markets for equity is like the biggest ocean of money in the world and is really powerful. So he wants this transition to happen, and he thinks it's inevitable, but it's going to happen. It needs to happen in an orderly way and for it to not move too quickly.
I appreciate the freedom that the degens are calling for just as much as the next guy, right? However, I think most people, including a lot of those degens, don't want the capital markets to completely destabilize. The question really is, how do we transition the capital markets on chain in a way that doesn't immediately destroy the old world? When the promise is fulfilled is when the regulations allow for a slow transition from the off-chain capital markets to bring everything on chain.
But Mike Cagney came at it from another direction. He directly spoke to one of the issues that is so hot in the conversations around stablecoins and yield right now, and says, based on where he's sitting, he very much believes like DeFi is ultimately gobbling up everything, and that specifically means that banks are going to lose a lot of deposits as folks start to figure out that they're better off putting that money on chain.
I think you're going to get a migration out of bank deposits on the Genius Act because of the stablecoin legislation. I think that money gets reapplied into DeFi. And I think what you're going to see is assets and liabilities move from the bank balance sheet onto a DeFi protocol.
Which brings me to my final thoughts and my promised big prediction about the final boom and bust that's going to come for the crypto world. So this is it. Real world assets are going to drive the true final boom, the final real cycle for crypto. I don't actually think that the all-time highs that we got in the last year were a true cycle. I think they were just sort of a rediscovery of the existing value of the stuff that we always had. They were a correction to the overcorrection of the Sam Bankman-Fried FTX collapse era. I think we just sort of like got back to the baseline of what these products are really worth as long as they are largely purely divorced from the real world. The value of crypto right now largely a world of bits, not atoms. This is driven by Ethereum and Bitcoin primarily, and everything else is kind of an also-ran to that. And it's all this sort of theoretical future and these use cases, which I believe are deeply important, but are not widely used yet in sort of this like payments rail system that hasn't quite fully evolved. But once we start getting real assets on chain, that is going to be a moment that is going to lead to enormous irrational expectation and is going to bring true speculative frenzy back to crypto. And in the mix of that speculative frenzy will be institutions and much bigger money than we've ever seen before. What I suspect is the early days of true adoption of real world assets is going to lead to something like the dot-com boom and bust that we saw in 1999 when it all came to an end. And the thing that people sort of forget, lots of these companies, lots of these early startups, they went public really fast to a degree that doesn't happen today. And so all these people started betting on this tech economy. And a lot of these companies, all these new players coming in, all this retail money coming in so fast and sloshing around so quickly, led to a lot of people doing day trading and people betting way too much of their money, people mortgaging houses and throwing it into the stock market. And it was a wild and zany era. It was so wild that it was like a big topic in the Doonesbury comic back in the days of the newspaper. The part of that I'll never forget is after the dot-com bust, Mike Doonesbury and his daughter opened up this company called myvulture.com. And what they did was they just bought the remains of different startups and sold them for parts later. It got very dark. I think the early days of true adoption of real world assets is going to work out to something like that in the crypto world. We have a way of getting very, very excited about change. And this will be very exciting because it won't be hard for people to make the case that these are real businesses that are really believable. And this is real money that's coming on chain with real tangible cash flows. And while I think that is 100% true and will lead definitely to better capital formation, real value for the world, globalized markets, much more liquidity, all good stuff, much more real pricing for stuff that has been harder to price over time. All of that will be fantastic. It just, we know how this works. In the early days, people are going to get too excited. So what do I think is going to happen? Well, again, not financial advice. I never do financial advice, and this is too vague to even be called financial advice, but I'm looking ahead to something that I'm calling the damage trade. And I plan to write about this more on Front Stage Exit soon. But the damage trade is just the idea of making bets in crypto now or soon that anticipate this enormous damage that's going to come from the over-enthusiasm about real-world assets, which seems inevitable to me. So what smart people will do, my guess, the people who make the most money off of it, is they will get in early and they will also get out early. It's going to feel like they missed a lot of gains at the point that they got out, but they will miss the rapid unraveling and the overcorrection to follow when this space gets way more valuable than it actually should, way too fast. The reason I call it the damage trade is because with real world assets, the crypto economy is connected to the actual world now. So things go up and go down super fast. It's not just your abstract coins in a portfolio that are suddenly losing value, but it's the collateral for loans that were made to pay for people's cars and houses or to cover their business operations. It's going to have much more grassroots consequences. This is something that I have been expecting for a long time. I've been seeing this as an inevitable future for at least 2 years now. Like everything, it's happened slower than I thought it would, but it's coming. Here's the important point. The big thing here is the economy doesn't even need to do well for me to be right about this. It doesn't even need to get better for this to be true just for crypto. All it takes is for more of the economy as we know it to shift on chain. That's all it takes. And that's already happened. It's already quadrupled in the last year. So watch for that. Watch for the damage trade. Bet on things that will blow everything up. That's the move here. Real world assets are going to lead to real world damage in the short term. In the long term, this is just the future of finance. It will all be normal and boring eventually. This is very obviously a recipe for irrational exuberance in the near term. Let's be realistic about how people in crypto can get pretty unrealistic. When you start to hear people saying this time is different, it's time to ask yourself if you've already made enough money. Don't get yourself into positions where you can't afford for prices to go down. Okay, so big picture, real world assets going to be an even hotter topic in 2026, I think, than it was in 2025. It's an exciting time for boring things. So before we leave, just want to remind everyone it would be great if you subscribed on Apple Podcasts or Spotify or Overcast or whatever. But yeah, thanks a ton for being here. Just remember, it's a beautiful world out there. But encrypt your files.
Every time I check the price, my Bitcoin to the sky.